Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look outside of the S&P 500 at other sectors, other indexes, other markets to try to get some insight as to what may ultimately happen with the S&P 500. This is being prepared for Monday, February 26th. Now, the first area that we look at is inside the S&P 500, and it has to do with valuation. There's a thing called the PE ratio, and this has static numbers. When something is giving us a PE ratio of 10 or below, that's considered inexpensive. If it's at 15, that's fairly priced. If it's 20 or above, that's considered to be expensive. So what we do is we look at a chart, and this looks backwards at the trailing 12 months. These are earnings reports that have already been released. The red dashed line is the PE ratio of 20. And when you compare that to the current price of the S&P 500, you can see that we are well above that PE ratio. So this would suggest that the market is overvalued. But also, by looking at this chart, you can see that that goes on for a long time. There can be many years when the market is acting in an overextended or expensive type of an environment. Another way of looking at this is put up by Real Investment Advice. This is pretty much that same chart. The black line is the S&P. Then we have the PE ratio of 20, 15, and 10 on the bottom, also showing that historically we are overvalued. This can also be compared to different events that have happened going back to 1980 and what the valuations were at that time. And then there's another way of measuring this called the Shiller PE ratio, which takes a smooth effect over about 10 years of earnings to try to get rid of outliers and to see what general trends are. The current reading for the Shiller PE ratio, which you also may hear referred to as CAPE, C-A-P-E, it's coming in at 34.25. Well, to give us some perspective, we can look at a chart to see that, yeah, this is pretty high. Other events that have happened, the 1929 crash, were even above where prices were at that time. We're well above where we were back in 1987 before that crash. And so this is suggesting, yeah, the market is considered overvalued at this time. We can look at another measurement here in the middle called the median and the mean. And the median is just under 16, with the mean being just a little bit over 17. The current reading is 34.25, so we're more than double what we normally would be. But at the same time, the market can go like this for a long time. We've been overvalued now for quite some time. The market doesn't use that, though. They look forward. What are forward earnings looking like? Well, we can also do PE ratios based on analyst projections and forecasts. The red line here is the S&P 500. And as of Friday's close, the current PE ratio looking forward is 20.3. All right, so we're getting a little bit expensive in that category. To compare it with some other indexes, we have the mid caps and the small caps. The mid caps are coming in at 15.5 as of Friday's close, and the small caps are at 14.9. So they're more fairly priced, where the S&P is considered to be overvalued. Here's another way of looking at earnings, also put up by Real Investment Advice. This just says that earnings estimates are well ahead of economic realities, and that's what we've been seeing. Whenever analysts come out and project earnings higher, and when they take those together for the S&P and they are looking better going out into the future, that justifies stock prices going up. And that's kind of what's being measured right here on this chart, just showing that maybe we're getting a little out of hand with the earnings estimates. Another way of looking at this is if you're an analyst and you come up with what you think a company's going to earn 3 years from now, well, you're probably going to be pretty rosy with that outlook. You want to be able to talk to people in the company. You want your emails and phone calls returned. If you start bashing the company, they're probably not going to talk to you. But then as that particular number that you projected out there gets closer and closer, you're going to need to revise that. And it typically gets revised down. And that's the yellow line that we see here. And this is very common to see this. They're really rosy looking into the future, but as it gets closer and closer, they have to work out more of a realistic situation. And so we see a tendency for things to be revised down. The dark blue line, that's how things were revised lower in 2023, but yet the market still went up anyway. This blue line is as of 2024 and how we're seeing the revisions coming in lower. So this is a very common thing to happen. We also look at growth versus value. Growth is when you want to buy low and sell high. Value are stocks that folks like to get into when they're more defensive. They're afraid the market's going to go down. We're hitting difficult economic times, and so they shift over to more value type of investments. The first thing that we look at is just a growth index all by itself. And this is in an uptrend. We have the blue line above the red line, and we're going higher. We compare that with the value index, which is also in an overall uptrend, as the market's been doing fairly well lately. Where we get some insight is when we do ratios between the two. We compare growth to value, and we can see here on the top part of this chart that growth is outperforming value. We also look at an inverse of that same chart showing how value is underperforming growth. And that's what we've been seeing now for quite some time. The reason why I show a lot of different indexes and ETFs and different lengths of time in the charts is you can see that when we had this crossover with the moving averages, they were slightly off of each other. And sometimes you can see things in an inverted chart that you might have missed when you're looking at more of a regular chart. So just looking at this in different ways can give us some different insight. Here's some ETFs comparing growth to value, showing how growth is outperforming. Here's an inverse showing how value is underperforming. Here's another look at the longer-term growth indexes that we looked at earlier, where we're starting to see growth really outperform here, and we're just about getting ready to cross with this ratio. And this also shows how value is underperforming. Then we look at some other indexes showing how growth is outperforming. And then we look at some other measurements here also showing how growth has been outperforming value and value has been underperforming growth. So we're seeing a real consistency here with growth outperforming value. Even though in and of themselves, value and growth are in uptrends, growth has been doing even better. And that's more positive for the market. We also break this down and look at some end-of-day charts. We look at the small caps. We look at a growth to value ratio, where we have been showing an awful lot of improvement as growth has been outperforming, even though we've been falling back lately. But it hasn't really affected the index all that much. We're not really seeing much of a breakout here. We also look at the mid caps, where they've been in a more sustained uptrend. They had been falling back after looking stronger. And this index is actually breaking out above previous highs, not an all-time high, but it's actually holding up a little bit better. And this is the one that I look at the most. This is S&P 500 growth to value, and then looking at it on a ratio, where we were showing a lot of improvement. We pulled back a little bit. We actually ticked down a little bit, even though Friday was an up day. But one thing that could be positive is we're getting ready to see a golden cross with this ratio after we had been negative. The longer we can stay above these lines, the more positive it will look. We look for convergences and divergences here. One thing that was a bit of a warning sign, when we were really going up from the October lows, we saw the growth to value ratio going down. And that led to some really difficult times of sideways action. And when this ratio finally turned around and started to go back up, that's when we saw a lot more strength in the market overall. We keep an eye on this. If this really starts to deteriorate, that can actually flow through into the index itself. We also want to keep an eye on inflation. On top is a monthly chart, the CRB index. This measures commodities, and that's pretty much flat right now. We do a ratio between inflation and deflation. This is going down. That means inflation has been subsiding. Here's the CRB index all by itself, where it is chopping sideways, but it is starting to show more of a downtrend now. And then we look at the Baltic Dry Index. When this is going up, it costs more to ship goods. When this is going down, it typically costs less. It's still in a longer-term uptrend, even after coming back down, but now it's starting to go back up. Some other markets, aluminum, which has been bouncing around quite a bit lately, but is still in a longer-term downtrend. Corn has really been falling down here lately, and that's in a downtrend. Wheat has also been falling down and is in a downtrend. And fertilizer, which has been coming down and then chopping more or less sideways, it has been bouncing back up a bit lately. Here's oil, which has an impact on all of us. We're still right in the 70 range right here. It's been really choppy lately. When we saw this thrust up here, up to 95, that's when things started to break out in Israel. Since that time, we've been falling back. Then this also looks at what different events have happened throughout time. And I've been showing this for a while now. When we spiked up, that was when the Russia-Ukraine war started. This other little spike up is when things started to escalate in Israel. That's why we watch the geopolitical events, because those things can often have a real impact on oil, which ultimately can have an impact on stocks. Now, oil can go up and stocks can go up at the same time if the companies are doing better, the oil companies. It's when something geopolitical happens that causes fear to come into the markets and oil jumps up for that reason. That's when it can put some pressure on stocks. We look at gas, which has been going back up, but is still in a longer term downtrend. This is diesel, also starting to go back up, but in a longer term downtrend. Heating oil also starting to go back up, but still in a downtrend. Natural gas has really been declining lately. And copper's been chopping all over the place. We're still in a longer term downtrend here, even though it has bounced up over the past week. We look at a ratio between copper to gold. Copper is usually outperforming gold when the economy is looking better going forward, where when we have high periods of inflation and uncertainty, that's when gold tends to do better. And lately, copper has been outperforming gold. It did decline a little bit late last week, but we're coming back above this moving average. Then here's a longer term chart. The copper to gold ratio, long term, that's the black line where it has been declining. And then we plot the 2-year yield and the 10-year yield on top of this. And we still see that there's quite a wide spread between these, and they're not necessarily moving in the same direction. If you look from 2012 up to about 2014 or so, or even longer than that, up to about 2016, they were having a tendency to go in the same general direction and not get too far apart from each other, even though they're on different scales. Now we've been seeing a really wide spread between all of these as the market tries to figure out what kind of a climate is going to develop. Gold continues to be in an uptrend, and after really coming back, was able to get back above its 50-day moving average in Friday's session. Silver continues to be in a downtrend, and we also do some gold and silver studies here. This is the closing price of gold on top, the closing price for silver. Then we look at the correlation between the two, and it is starting to get stronger after it had been really weakening. Now, you would think if gold is up, silver should be up, and if one is down, the other would be down. And for the most part, when we get a high reading here, that's what that means, that they're going in the same direction. But sometimes they can get disconnected from each other, so we want to keep an eye on that. Then we also look at a gold to silver ratio on top. When this is going up, that means gold's outperforming. When it's going down, that means silver's outperforming. And we can measure the US dollar index because sometimes we can get some insight. The gold to silver ratio and the dollar index sometimes really follow each other. Right now, they're not following each other all that closely, so we're not getting an awful lot of insight from this chart. Here's just a look at the US dollar index, where it did fall just a little bit in Friday's session, but it has really been bouncing up since the beginning of 2024. This going up typically puts pressure on stocks because of conversion rates, because of import-export price changes that need to take place. The stock market likes a weaker dollar. And so when we were having some problems earlier in 2024, that was pressuring stocks. If this continues to go up, that may be a concern for the stock market. Then we look at the euro, which has been declining when compared to the US dollar index. We also keep an eye on the Japanese yen, which is in a downtrend. And then I have a breakout chart. Here's the euro, which is falling underneath both the moving averages, but it's still in a longer-term uptrend, so it's outperforming the dollar. We keep an eye on the Japanese yen, which is in a downtrend compared to the dollar. The British pound, which has been chopping around, is still in an uptrend compared to the dollar. And then we look at some different indexes, and I show this in every daily video. The red line is the equal weight index, where all stocks are treated the same. The S&P 500 itself is a weighted index, and so when the big mega cap companies have an up or a down day, that can have more of an impact on the S&P. To get more of an idea of what the broad market is doing, we look at the red line, and the red line's been showing some improvement lately. Here's another ratio that we look at, but for the most part, when this ratio is going down, that means that the equal weight is underperforming the S&P 500, and that's what we've been seeing a lot over the last year or two as the big tech companies, the mega caps, the Magnificent Seven, they've been really outperforming and having a large impact on the value of the indexes, especially when you apply it to the S&P and the NASDAQ 100. Then we look at a ratio between stocks and commodities, showing that stocks are outperforming. This is also an inverse, showing how commodities are underperforming. This is the NASDAQ 100, which is near all-time highs, and the S&P, which set an all-time high in Friday's session, showing that the NASDAQ 100 is actually outperforming the S&P 500. There's only 100 stocks in the NASDAQ 100, and pretty much all of those are growth companies and mega caps and big tech companies, where the S&P has those stocks too, but it also has more value stocks, and that's why it's normal to see it underperform. We compare the S&P 100, which are the biggest stocks in the S&P 500, with the S&P itself, showing how the S&P 100 is outperforming. The NASDAQ continues to outperform the S&P 500. The NASDAQ 100 is outperforming the NASDAQ. And then we look at mega cap, the really big companies, and compare it with the S&P, showing how the mega caps continue to outperform. Then we do a ratio with small caps. When this red line is going down, that means that the small caps are underperforming. And that's pretty much what they've been doing. We saw a nice little bump at the end of 2023. Since that time, small caps have really been under pressure. The blue line here is the S&P 500, just to give us a little thing to compare it to. And we also look at a ratio. When this is going down, that means small caps are underperforming the S&P, which is what they're doing now. These are the biggest software companies in the US, which they're now looking stronger and in an uptrend. Here's the mega cap, which is back to setting all-time highs with this ETF and in a really solid uptrend. We look at the robotics and AI ETF. That's all the craze right now. And it is in an uptrend when we look at it by itself. And it's showing some improvement, but it has been underperforming when we compare it to the tech sector. This is the Dow Jones Composite Average, where we take the Dow, the transports, and the utilities and put them together. This is in an uptrend. Now, most of this strength is coming from the Dow. The transports aren't doing all that well, and the utilities are actually in a downtrend. So the fact that this is in an uptrend is really attributed to the Dow itself. We compare the S&P 500 with shorter-term bonds ranging from 1 to 3 years. This is showing how stocks are outperforming bonds. We look at a broad market, the S&P 1500, and also compare it with shorter-term bonds, because it's like, okay, if the mega caps are doing all the outperforming, this ratio should be going down. Well, it's actually going up, showing that stocks are outperforming even when we look at the broader market. This is another newer measurement that I just started using, and this is the total US stock ETF. And inside this ETF are 2,651 stocks. If it was only a small number of mega caps that were contributing everything to the market, which they're having an impact, I'm not trying to discount that. But would this total stock ETF be going up and setting all-time highs? No, it wouldn't. We've surpassed the previous all-time high, and it's continuing to go up. So yeah, even though the mega caps, they're having the most impact, there are still other stocks that are doing quite well. And when we look at this very broad measurement of the market, this is in a solid uptrend. We look at the broad market and then look at further out bonds, also showing how stocks are outperforming. Low volatility stocks, which really chopped around more in 2022 and even into 2023. These are stocks that folks get into when we're starting to run into some problems with the market. They may go down, but they're going to go down less than some of the growth stocks. The interesting thing about growth stocks or high beta stocks is that they do a great job of outperforming the market when we're going up, but unfortunately, they underperform the market a lot more when we're going down. And so we're seeing a longer-term uptrend here with the low volatility ETF. There's folks that are more defensive in the market right now, and this ETF has been holding up fairly well. Where we see it break down is when we do a ratio between the low volatility ETF and the S&P. This has really been underperforming. Then we look at the tech sector, which is really outperforming 3 to 7 year bonds. And then we look at some other stocks. Now, I show this in every daily video, but I like to go through it here because it goes across different markets. This is some advanced decline line studies. On top is the NYSE, just the common stock. And this is showing some improvement, and we're above the moving average, but we haven't broken out against this previous high or this high a little further back. So it's lagging a little bit. Or if you look at the S&P, it's back and setting a new high here. The mid caps are showing some improvement, but not really breaking out. And the small caps, they're above their moving average and showing some improvement, but also lagging behind currently. This also suggests that the bigger stocks are really outperforming the smaller stocks. Then we look at Dow theory, and this has been really frustrating lately, where we have the Dow setting all-time highs. The transports can't even go back to these previous highs here, yet alone set an all-time high that it was set back in 2021. This is a bit of a concern that the transports are underperforming, and we're in a pretty solid downtrend when it comes to the utilities. To break this out a little further with the transports, it looked like we were breaking out above this high that was set in late 2023, but then we fell back. The other high was set in July of 2023, where the transports were doing much better, and the all-time high was set at the end of 2021. If the transports could finally get some positive price action under them and really start to go up, that would confirm the all-time highs that we're seeing in the Dow. Until that happens, that's a negative divergence. It's a non-confirmation. And if you apply much of Dow theory to the way that you make decisions, that's a concern to you. And we just want to keep an eye on this for right now. Then we look at a ratio between the transports and the S&P, showing how the transports are really underperforming. We look at another ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. We look at the relationship between the S&P on top and the transports in the middle, showing that they're not really having a strong relationship right now. When we get a high reading, when this really goes up, that means they're going in the same direction at the same time. And this is another area that we're keeping an eye on. This would also help make things look more positive if the NASDAQ was able to go back and set a new all-time high. That would help confirm what we're seeing in other indexes. We're close, but we're not there yet with the NASDAQ, where the S&P is making new all-time highs right now. The FANG index also is really close to setting an all-time high, even though it was down slightly in Friday's session. And I'm keeping this chart in focus just in case we start to see some weakness here. There are some different areas of support that we might hit. ARC continues to be in an uptrend, and this is a monthly chart of the S&P, and we compare it with stocks in Europe, Australia, Asia, and the Far East. And this is monthly, so this is very long term. And what you see here is the ratio. When we're above this red line, that means that the S&P is outperforming, and we've been doing that for quite a while. We look at a momentum oscillator on the bottom, the PPO, and that's above zero and advancing. And that's suggesting that compared to the rest of the world, the S&P is outperforming on a longer-term time horizon. Then we look at the total bond ETF. These are bonds based on price, where they are still in an overall uptrend, even though they've been falling back lately. This is the Pring World Bond Index, which is also in an uptrend compared to price, but they've been falling back as well. We look at a monthly chart of the stock to bond ratio, which continues to show us that stocks are outperforming bonds. This is a daily chart showing how bonds are underperforming stocks. So we have a longer term look and then a shorter term look here. These are high yield bonds, also known as junk bonds, and they're not necessarily setting all-time highs, but they're really doing quite well and have been for quite a while. Corporate bonds are also showing some improvement and are in a longer-term uptrend, even though they've been pulling back. These are more conservative bonds. Then we do a ratio between riskier bonds and more conservative bonds. When this is going up, that means folks are favoring junk bonds, and that's what's been happening lately. We look at a correlation between stocks and bonds, where they're kind of just on a little bit upper from the neutral area right now. This blue line to red line, I consider that neutral. We are bouncing back up, so they're having a slight tendency to go in the same direction at the same time, but it's not a really strong relationship. We look at the corporate bond index, which has been falling back lately, but still in an uptrend. And this is a look at the 10-year yield, where we set a real high up at 5% back in October. We've fallen since then, but now we're starting to go back up, and this is causing some concern in the markets. This is a longer-term look at the 10-year yield, where we've been seeing for 40 years now a series of lower highs and lower lows as the interest rate environment has been coming down. We're wondering, are we shifting back into a higher interest rate environment? And that is yet to be determined. This is a chart that I've been using for quite a while now. When we spiked out at 5% last October, That's this line right here that you see on this chart. Okay, and that's considered to be a positive thing because the reason we hit that 5% level and then started coming down, the market got this idea that, oh, we're going to have a soft landing. We're not going to go into a recession. Oh, the Fed's going to start cutting interest rates. Oh, everything is wonderful. That's a positive thing. But if you look back here, the other times we had really low readings like this was the Euro crisis back in 2011. This was the COVID plunge, which certainly was not positive. So we have two negative events and one positive event here. We're still waiting to see this played out. We don't really know yet. We'll only get some hindsight to look back at this and go, oh, that's what was really happening. But until we get some more insight, we just want to keep an eye on this. This is the 30-year yield, which just shows you, and then I put some Fibonacci retracement lines on here, and we're far away from those. This is the S&P 500 comparing it with the 10-year Treasury yield, showing how stocks are outperforming. This is showing how bonds are underperforming stocks when this is going down. Junk bonds continue to do quite well and are in a pretty solid uptrend. When we compare them with more conservative bonds, junk bonds are back to outperforming. This is a look at the 7 to 10-year bond ETF, which is in a longer-term uptrend. We've seen a recent golden cross here, but we're below 50 with the RSI, and momentum since the beginning of February has been negative after turning a little bit positive. It's pretty much been negative for all of 2024. So bonds based on price have been under pressure as interest rates have been going back up. This is a daily chart of all the different interest rate maturities here, showing how we are starting to go back up, even though we declined a little bit this past week. This is a weekly chart looking internationally where we have US rates, German rates, the UK rates, and Japanese rates, how they've all been going back up as well. On top, we have the MOVE index, which measures the volatility of bonds. We have the VIX in the middle, which measures the volatility of stocks. And right now, they have a pretty strong correlated relationship, meaning their volatility is tending to go in the same direction at the same time. This is a monthly chart of the price of the 30-year bond, which has been in a downtrend for quite some time. But when you compare it to commodities down below, we are seeing where bonds are still in an uptrend compared to commodities on a monthly chart. Then we look at different sectors. We look at, there's 11 sectors that make up the S&P 500. One of them is the materials, and we do a ratio between what's the materials doing by themselves and the S&P 500, and we compare that with each other, and we can see here that the materials are underperforming and are in a downtrend. Communication falling back a little bit, but still in an uptrend. It's been in one of the stronger areas over the last couple of years. Energy has really been underperforming and is in a downtrend compared to the S&P. The financials are still in an uptrend. We're waiting to see. The New York Community Bank came out with some problems a few weeks back. That's all we've been hearing about so far. We're wondering, are there other shoes to drop, so to speak? Are other banks going to come out with some problems? And that's where we saw this ratio come under a little bit of pressure, but so far we haven't been hearing anything. The industrials are showing some improvement here, but still in a longer-term downtrend compared to the S&P. The tech sector, very strong compared to the S&P. Staples are underperforming the S&P. Real estate's really underperforming the S&P. When interest rates topped out in October and started to go down, we saw a real improvement with real estate, but since interest rates have been going back up, we've been seeing this ratio going down. Utilities are also, they tend to suffer in a rising interest rate environment, so they've been in a downtrend. And we look at an S&P to utilities ratio. When this is going up, that tends to mean the S&P is going up as well. And that's what we've been seeing lately. Healthcare, which is continuing to underperform the S&P. Here's another chart showing how it's in a downtrend. Discretionary, which should be doing better than it is, but you can blame Tesla for a lot of that because it's really been under pressure and underperforming. In a good, solid environment, we want to see tech, communication, and discretionary doing well. And discretionary has been one of those lagging areas. Staples sector, which these are things that you have to buy no matter what's going on in the economy. It's kind of interesting. We're in an uptrend here. Usually in a stronger economic environment, we might see this go down. The tech sector continues to be in a solid uptrend. Semiconductors also in an uptrend and setting recent all-time highs. The tech sector compared to the S&P 500 shows the tech sector is still outperforming. When we compare energy with tech, This shows that energy is really underperforming the tech sector. Growth continues to outperform more conservative bonds. And here's a look at the tech sector compared to the 10-year yield, showing how the tech sector is outperforming. Here's an inverse showing how the 10-year yield is underperforming the rise in interest rate, or that it's okay. This is another chart of the energy to tech sector. I meant to put a different chart in there. And this shows, even though discretionary has been having some problems, it's still outperforming staples when we do a ratio. And this is also showing how staples are underperforming. Gold continues to underperform the S&P, and gold is also underperforming the dollar. High leverage loans are continuing to hold up quite well. These are very risky, and the fact that these are going up makes you think, well, maybe the economy is going to do okay after all. And here's the NYSE composite. This is one of the broad market measures that we look at. It is in an uptrend and setting new all-time highs. All stocks also uptrend, all-time highs. Emerging markets are chopping around a lot, but are still in an uptrend for right now. And this is another chart that I've been showing for a while. This is comparing emerging markets with US stocks. When this gets to a really low level, that's a lot of times when folks want to go in and start buying emerging market stocks. Well, we're not really seeing a lot of follow through with that, at least yet. This is also looking at different emerging markets outside of the US. The red line here is the S&P 500, and this is a bit outdated now, but we have stocks in Mexico, India, Turkey, Indonesia, and Brazil, and there are ETFs. So if you want to get some international exposure, this kind of gives you an idea how they were performing, at least until about the latter part of 2023. But some folks like to do that to get more diversification. Then we're looking at the Bank of America. They're the ones coming out saying, we think Japanese stocks are finally going to surpass the high set back in 1989. Well, you know what? They did. Not by very much, but just this past week, we've now seen a new all-time high with the Japanese Nikkei index. And looking at the microcaps, these are smaller companies. They continue to be in an uptrend. We look at the home builders, and I have a whole study here, but when we get down to where I have these yellow areas marked, that's really when we only pay attention to this. Bitcoin continues to be in an uptrend, is really enjoying the idea that now there's ETFs available that you can get. Looking internationally, China's in an uptrend. The emerging markets are in an uptrend. We're turning back up in Europe. We're pretty much flat to slightly higher in Japan, and we're kind of flat right now with the S&P. This is the KST, which is a very long-term oscillator. And we look at an intermarket analysis chart where oil has been doing the best going back to the beginning of 2024, followed by stocks and the dollar, where gold and the price of bonds are negative. Looking at some correlations between the S&P and the dollar, where they're having a slight tendency to go in opposite directions of each other. We look at the S&P and oil. It's pretty much neutral right now as the market figures out what it wants to do. We look at the S&P and the 10-year yield, also neutral right now. And the tech sector, they're having a slight tendency to go in opposite directions from each other. When we get a high reading, that means they're going in the same direction. The lower the reading, the more that they're going in opposite directions. And we look at another yield of the S&P to the 2-year yield. This is neutral right now. Then some longer term charts. This is a monthly chart of the NYSE on top with a moving average showing that we are in a longer term uptrend. We look at the Koppik curve, which is another momentum oscillator. That is also positive. There's a daily chart with the NYSE and then a thing called the NYSE record high percent index. When this is going up, that's positive for the market. Then we look at the S&P, which is also, this is a monthly chart, and it's above the moving average. So longer term, we're still positive, and the PPO continues to go up. Then we look at the S&P on top and then a ratio down below between the S&P and commodities, showing that stocks are still outperforming commodities. And we look at the S&P on a monthly chart and compare it with another global look. When this is above the moving average, that means the S&P is outperforming. And the KST is pretty much on top of itself right now, but it's just possibly starting to turn more positive. Since this is a monthly chart, this can take some time to develop. Then at the very end, I look at some different areas and I say, what are those things that are positive? My definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. So we have the growth indexes and value indexes. Copper, the British pound and the euro compared to the dollar, gold, the big software companies, mega caps, the FANG index, ARC, low volatilities stocks, the staples, the Dow Jones Composite Average, all the different bonds based on price that we look at, the high yield bonds, investment grade bonds, corporate bonds, junk bonds, world bonds. Even though they've been falling back in price, they're still in longer term uptrends. The tech sector and the semiconductors, high leverage loans, the Dow, the NYSE, the NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps, all stocks looking not only in the US, but also outside of the US, emerging markets, and Bitcoin. Then on the last slide, I go through and talk about what things are negative. And this is when the 50-period simple moving average is below the 200-period simple moving average. The dollar is still in a longer-term downtrend, even though it's been bouncing up since the beginning of 2024. The CRB index has also been going sideways, but still in a downtrend. Silver's in a downtrend, the Japanese yen when compared to the US dollar. Thank you. I really hope you found this helpful. Please feel free to check out the daily videos, the weekly videos. After I finish with this video, I'll be doing what I call the deep dive video, where I go through all the charts that I really didn't talk about much this week, and I prepare those in a separate video. Have a great weekend, and I will talk to you in the next video.